Hello, welcome to this newsletter. Certainly, February was an interesting month. We're going to look a bit back on February and give you my ideas on where markets are currently, and then end off with what our current strategy is in terms of money that's in the market being phased in and new money. Monique, welcome. I look forward to the next 20 minutes.
Thank you, Theo. February was indeed an interesting month. We had the SONA as well as the budget. What were your key takeaways from those two speeches?
Look, I think let's rather focus on the budget, because I think the budget is an outflow of the SONA, the elements that the president set out as government policy or plans for the year. But let's look at the budget. I think we need to, there's two angles that one should take and one should look at. The first one is, remember in October last year, we had a kind of a COVID updated budget. And I think one first needs to look at it in terms of that budget, and then physically what was in this budget. If you compare it to the COVID budget of October last year, the economy did better than the minister at that point expected, to such an extent that almost to the T 100 billion rand more in terms of income, that in terms of tax revenue was received by government, which in effect is very good news. It shows you that there was a more robustness in the economy than we expected in October. Secondly, in October, the minister indicated tax increases to the tune of about 40 billion rand over the next 3 years. That luckily is off the table. So that is compared to the budget that we saw in October. But if you look at this budget on its own, we need to remember that the government finances, our fiscal position is in terrible shape. It is not in a good shape. Firstly, 21 cents out of every rand of taxpayers' money received is spent on servicing our debt. Now, that is not sustainable. If you take the level of government debt and you look at the size of the economy, or you look at the shortfall in terms of expenditure and income, it is not a good picture, and we need to aggressively do something about that. Although again, against the October budget numbers, it's slightly better, it is not the position we want to be in. If you then compare to the cost of our borrowing, the level of government bonds, the level of which we have to borrow, that is simply not sustainable. So from that point of view, I think it is very important that the minister was quite clear that the government doesn't have a lot of options, and the government's finances is under very strong pressure. What also was noted, and I think that is going to be a debate as we carry on, is the level of increases in government employee salaries. Now, if you look at what was budgeted, and it's a very small increase over the next 3 years, you're talking about 1.2% per year. And then you look at the trade unions, the government employee trade unions, expecting or demanding increases of inflation plus. Now, their number is 5 or 6 times what government has in the budget. I do think that is a negotiation strategy, but it is going to be difficult, and that's going to test to a large extent where we go. We also note, yet again, usually when we have elections coming, and remember, we are scheduled to have the municipal elections somewhere in August, September, October of this year. It's still debatable if they might be postponed because of COVID, but we are scheduled to have those elections. And normally, this time you find that COSATU, which is part of the tripartite alliance that technically governs South Africa, is always round about 6 months before elections debating if they are going to support government or not. That is not unusual. What this time makes it a lot more pertinent is the fact that COSATU, to a large extent, is now a government employee trade union. A lot of their members are in the civil servants, work for government, which makes it difficult. On the one hand, government is trying to cut expenditure, and on the other hand, the COSATU membership, specifically those in government employees, is asking for big increases in wages. And now you have this whole thing about, will COSATU support the ANC or not? Remember, COSATU and the SA Communist Party, the two other parties in the tripartite alliance, usually before elections, they start to debate this, and they make a lot of noise about it, basically to try to get some some policy commitments from the ANC. So that is not strange. What is this time around making it difficult is the state of government finances. So looking at the budget as the budget, South African economy is under incredible pressure and state finances under incredible pressure. If we are not going to get the economy growing, this thing is going to struggle and be with us for a while. However, relative to where we were in October, at least it's looking a bit better.
Thank you, Theo. And given all this information, what trends are we seeing in local and offshore markets at the moment?
Look, I think we've had a very strong February. Both locally and internationally, we have had a strong month of February. And I think there's a few reasons for it. The first reason is, remember, economic recovery will depend on to what extent the medical fraternity, or rather science, can get a grip on COVID. And we're seeing in the big industrialized countries in the world, the vaccination programs are really being pushed, and they are starting to show some real successes. So that will be a positive. The other point is, I think a lot of companies have actually the results coming out, not only in South Africa, but worldwide, is somewhat better than expectations. And the reason for that is not so much that the economy is doing well. So a lot of companies cut back on staff members, cut back on expenses, and they're in a better shape from a company point of view. That doesn't mean that the economy is in a better shape. There's a big difference between those two. So we are seeing better results. I just think there is a bit of caution that there's certain sectors, not only in South Africa, but worldwide, that are starting to look very expensive. Specifically, some of the big tech companies. One must be careful. As we go back to normal, we cannot expect that the fact that we did everything online is going to be the new norm. The new norm will be slightly different, and I think one needs to be very careful. Some of those entities are overvalued, but then the rest of the market is actually not that expensive. So on balance, yes, sectors that are overvalued, but the rest of the market not that much. In South Africa, we also had the whole, in the budget, the minister noted that Treasury will issue a document on Reg 28. Now, Regulation 28 is the regulations in which pension funds are allowed to invest their money. And there's been a lot of noise and a lot of scaremongering that government will force pension funds to invest in certain assets. And the story was that government will force pension funds to bail out SAA and to bail out SABC and to bail out Eskom. Well, the Regulation 28 working documents came out late last week after markets closed. But the important thing there is, and this is what Treasury has always said, it is to a large extent to make it easier and more and possible for pension funds to invest in developmental projects. So it's not changing the mandate, it just makes it easier and makes it easier for trustees of pension funds, who ultimately is responsible for the performance, to invest in developmental assets. Now, I would be comfortable if, let's for argument's say that a project, a water works project or an electricity generation project were to go through the normal process of project finance, and in the end you find a vehicle that allows a pension fund to invest in those projects. I actually think that will be a good thing, as long as it's purely on commercial terms and not being forced. And it seems that that is the way Treasury is going with the changes in Regulation 28. And one would hope that that'll take a bit of the uncertainty around these regulations out of the picture. This is a document that's for public comment, but hopefully in the next few months we will get the final product, and then we will see how the market will implement it. If it's purely making it easier for pension funds to invest in developmental projects based on commercial terms, based on the risk return of those projects, I think I'll be happy, and I think the market will be happy. The issue was, if anything is forced, at this point it doesn't look like it. Monique, can we change the focus a bit, just to again just elaborate on our house view in terms of investing locally, in terms of offshore, and a bit about the levels of how we see certain levels and where we believe one should invest to what extent. Monique?
So for offshore investments, we are comfortable taking capital offshore at anything below 16 Rand to the dollar, because we believe that is a new fair value for the Rand. And then once the capital is offshore, we recommend phasing it in over a 6-month period. As you mentioned, there are sectors in the market, both locally and offshore, which are quite expensive, and it's just to counter some of that volatility. Now, in local markets, we are recommending a 3-month phase-in, and this is for new capital. So any existing capital that's already part of a phase-in strategy, we're sticking to that strategy.
So if you are already in the process of allocating capital, there's a specific strategy, and we're comfortable that we stick to that strategy, those phase-in periods. But where it's new money, the view is that although the Rand is currently stronger than 16, we believe that anything below 16 actually makes sense. But then we are more concerned about possible volatility in international markets. So although we'll take the money offshore immediately at these levels, we will phase it in internationally, specifically because there is a chance of volatility, specifically around those IT or high-tech sectors that are relatively expensive and might create some volatility. The local market, 3 months, and I do think that as the local economy starts to get moving, the kind of strength we've seen in underlying equities will remain there. And hopefully we will get, I don't think one can expect that the movement we saw in the last 3 months will continue. There will be volatility, but we're in a better position giving corporate earnings than we were specifically in the middle of COVID.
Yep,
so
I agree, Theo.
Monique, from my side, thank you very much, and thank you for your participation. We in March, can you believe it? There's the first 2 months of 2021 is something of the past, and let's hope that this bit of relaxation, the fact that it seems that we have gone through the second wave, let's hope that in the next 2 to 3 months we see enough developments and enough movement that should we get a third wave, it will not be as bad as either the first or the second wave. But I guess nobody can predict, and I still maintain that I have full confidence in the medical science that as time goes on, we will move into a better position. So stay healthy, all the best, and we talk again in a month's time.